We have heard it over and over again from so many financial experts. Buy term and invest the difference. But is it really what it's cracked up to be? Stay tuned because what we're going to do is use math to find out. If you spend any amount of time in the infinite banking world, you will hear the phrase from time to time, buy term and invest the difference. Hi everybody, it's Russ and welcome back to my channel where today we're going to talk about buying term and investing the difference. This is a phrase that is very common amongst financial experts like Dave Ramsey or Clark Howard who just really don't understand the infinite banking concept. But what I'd like to do is I'd like to be fair to the conversation. I want to give them a chance to prove that buying term and investing the difference in something like the S&P 500, which Dave Ramsey claims you can get a 12% return on your investment year over year, we're going to find out if doing that compares better to using the infinite banking concept. And we're going to do that with mathematics. Now, before I get into investing, I want to take a moment and talk about what the infinite banking concept is, because there may be many of you tuning in right now that have never heard of this. So let's take a moment and cover what it is exactly. So the infinite banking concept is a system of taking back control of the banking functions in your life. And that can be done with any type of savings vehicle, like a savings account, a money market account, a CD account, your 401k, but basically any savings vehicle where your money is sitting protected is what we would use to do the infinite banking concept with. And what we do from that savings vehicle is we do things like invest or pay off debts. Now, maybe in your situation, you happen to carry some debts. And of those debts, you have 2 credit cards that carry balances, and maybe you also have a mortgage that you're paying off on, and also you happen to have student loans that you need to pay off. Well, when you have this savings vehicle, let's say, for example, that the company that is providing you this savings vehicle is providing you with some special benefits that you can't get anywhere else. And what are those benefits? Maybe in this situation, they are giving you a guaranteed interest rate. And I'm talking about a contractually guaranteed interest rate that never changes year over year through the entire course of your whole life. And that doesn't matter what the economy is doing or what the stock market is doing. You will always get that guaranteed interest rate. But on top of that, they're also providing you with an annual dividend that is paid based on the profits that they make each year. And the reason they're doing that is because they're allowing you to be part owner of the company. You are a shareholder, which is a neat benefit to have. And all the growth that you get in this interest and dividends happens to be tax-free. Now, you will not get that in your savings account. You won't get that in your money market account or your CD account, and you won't even get it in a traditional 401k because that is tax deferred until you take it out later. Well, in this case, as long as you follow the IRS rules, it will be tax-free. And there are some other benefits they provide. Maybe this savings vehicle also is protected against liens and judgments in most states. And also, it provides a legacy, which pays out to your heirs when you pass away. So what are we going to do to pay off these debts? Well, first of all, let's say that we have a credit card that carries a balance of $10,000 where you've been paying 24% interest and your monthly payments have been $300 per month. So how are we going to pay this off? Well, instead of doing a withdrawal from our savings vehicle, the company is going to give us an opportunity. We can take a loan against our savings vehicle. And in the savings vehicle, let's say that we have saved up $10,000 into this account, And it just so happens that the growth on this account is 6% year over year. Now, instead of drawing the money out, which when you do that, you deplete the account and it is no longer compounding, in this case, we're going to take a loan because the company is going to provide you with their money to borrow, and they're going to let you keep your full 100% of your money in your account to continue compounding uninterrupted year over year. So we will take a loan. And this loan, we will have to pay them back at 5.75% interest. Now note that your account is growing at 6%, but you're going to pay them 5.75%, which means that your money is going to continue to grow uninterrupted, even though you're paying interest on this loan. Now, when you take out this $10,000 loan, we are going to turn around and we are going to pay off the credit card. Now, most people, what they would do in this situation is they would say, all right, great, I've paid off the card. I don't need to do anything else. But that's not what we're going to do. What we're going to do is, since we have been making these $300 a month payments to their bank, and it has been leaving our pockets month over month and going to them, and we never see that money again, what we're going to do is we're going to turn around and we're going to do what's called a recycle and recapture of our money. And we are going to make $300 a month payments back to ourselves. And when we make these monthly payments back to ourselves, we pay it back to the loan that we owe the company. So over 36 months, we will have this $10,000 loan paid off. And so what happened there? Well, first of all, the interest that we paid the company over 36 months was $912, but we saved over 36 months $5,601 from the credit card company because we started paying ourselves back at 24% interest. And our savings vehicle has grown over 36 months by $1,826, which means that now our account has grown to $11,826. And we have a paid off credit card. And that is the basics of how infinite banking works. But let's go a little further. Now that we've paid this card off, let's say we have the second credit card that carries an $8,000 balance and we're paying 26%, and we've been paying $250 a month. Well, we're going to do the same thing. We're going to draw out $8,000, actually through a loan, not a withdrawal, and we're going to pay the card off just like we did the previous one. And now we are going to recycle this $250 a month back to ourselves. Now, please note, you see that it says you're paying back $550, even though the original amount that you were paying this credit card was $250. Why is this? Well, it's because you had the $300 month payments from the previous card that is now freed up cash flow that you can lump in with this $250 to speed up the velocity of paying off this debt, which means ultimately you will have this paid off in 15 months back to the company. And over those 15 months, you will have only paid them $310 in interest, but you will have saved $1,456 in interest from the credit card. And your savings vehicle has grown over 15 months by $894. And that is how the infinite banking concept works. But I want to say something that is going to floor you. What is this savings vehicle that we're talking about here? Is it a savings account? Is it a money market account or a CD account? No. These very benefits that I just covered are provided through, and here it comes, a whole life insurance policy. Oh no, Russ, there is no way I am going to buy a whole life insurance policy. I get it. I understand. That has been drilled in our heads year over year for many decades. But I want to say something about these whole life insurance policies. These are specially designed, and I'm going to say that again. They are specially designed and engineered whole life insurance policies. They are not your standard garden variety, buy it off the shelf whole life insurance policy that Dave Ramsey, Clark Howard, or the money guys rip into day over day. That is not what we're talking about. As a matter of fact, in the United States, there are over 700 insurance companies. And of those 700 companies, there are only about 10 of those companies that provide the very policies that we're talking about here. So what makes them unique? Well, what makes them unique is that they provide high early cash value, which means that you can access most of your money within the first 30 days of opening the policy. Now, you can't get that in a standard whole life insurance policy. As a matter of fact, you wouldn't have access to your money in most cases for 2 years, and in some cases for 3 years. Well, that's not the case in these policies, and that's what makes them special. So now that you understand what the infinite banking concept is, let's put Dave to the test. Let's find out if buying term and investing the difference in something like the S&P 500 will actually yield more money than using the infinite banking concept through a whole life insurance policy. And we're going to follow Dave's rules to the letter to make sure that both attempts are apples to apples. Now we're going to start with Dave's method. And in order to do that, we need to have some assumptions. And so let's start with a few assumptions right off the bat. To begin with, this individual will have a 27.75% tax bracket that will include federal taxes as well as state taxes. This individual also has $12,000 sitting in their savings account that is currently earning 6% interest. Now, to be fair, I don't know of any high-yield savings account that provides 6% interest on their money. However, just for argument's sake, let's say that 6% is what we're going to use today. Now, this individual will draw out $10,000 out of their savings to invest in the S&P 500, and we're going to make an assumption based on what Dave says, which is that you can earn 12% interest on the S&P 500 year over year. We're going to go with that assumption. So this individual will have to buy a term life insurance policy, which will cost them $217.50, which leaves them with $9,782.50 to invest in the S&P 500. So now we're going to do the math. We're going to find out if Dave's method of investing this money in the stock market, specifically the S&P 500, is going to actually work, and we're going to see how that plays out. In this case, this individual, after 1 year, will have received a gain from their investment of $1,173.90, which is not bad. However, they have to pay taxes on this. So at the end of the year, they have to pay $325.76 in taxes, which leaves them a net gain of $848.14. Now, meanwhile, in their savings account, they still have $2,000 sitting in there, which is yielding 6% year over year. So at the end of 12 months, the savings account has grown by $120. However, they also have to pay taxes on that gain. So the taxes will be $33.30, which leaves a net gain in the savings of $86.70. So overall, their entire capital at the end of the first year comes to $12,934.84. That's not a bad day in the office. But let's find out if we use the infinite banking concept through a whole life insurance policy and we use the same rules that Dave has provided and we will invest in the S&P 500. Let's see what happens going that route. Now, to do the infinite banking concept method, we're going to have to use some of the same assumptions that Dave used on his end. And in this case, we're going to stick with the same 27.75% tax bracket. And our whole life insurance policy has a cash value of $12,000 that earns 6% interest year over year. Now, what we're going to do that's a little different is we're going to actually take a policy loan against the policy of $9,782.50 that is being charged 5.75% interest. Now, why only $9,782.50? That is because in these whole life insurance policies, we have already purchased a term life insurance policy that is attached to the whole life policy, and in this case, it also cost $217.50, which is the same price that Dave used when he bought his term policy. So we're going to invest this $9,782 into the S&P 500, and we're going to have the same return of 12%. Now, doing the math, what you will see here is the gain from the investment is the same as Dave's gain. It is $1,173.90. Now, the taxes that are owed on this is $325.76, which leaves us a net gain from the investment of $848.14. However, this is where things change. If you look at the policy growth, you will see that the policy has grown by $720 over 12 months. Why is that? It is because these whole life insurance policies, when you take a loan, you are taking a loan from the insurance company's money, not from your policy. So your entire $12,000 is still in the policy growing at compounding uninterrupted interest. So in this case, it's grown by $720. Now, there are no taxes owed on this money, and it's because we took a loan. However, we do owe interest to the insurance company for the money that we've borrowed, which is $307.34. So at the end of the year, our net gain from the policy is $412.66, which means that we have a capital gain at the end of the year. All total, our money has grown to $13,260.08. So as you can see, after 1 year, the infinite banking concept through using a whole life insurance policy, taking a loan from it, investing in the S&P 500, and yielding money where it's working for you in two places, actually generates $325.24 more than Dave's method after 12 months. It is unbelievable. So is it true that buying term and investing the difference actually works? Well, yes, it does, but it works better using the infinite banking concept. Thank you for tuning in, and I'll talk to you soon.